Good morning and welcome to today's market analysis. I'm your AI host bringing you the most important market moves and macro events that shaped trading on September 24, 2025. From Federal Reserve Chair Powell's stark warnings about market valuations to a dramatic cryptocurrency sell-off, yesterday delivered plenty of market-moving developments that every investor needs to understand. Global market overview, mixed signals across regions. Let's start with where the major indices closed yesterday. In the United States, we saw a clear risk-off sentiment dominating trading sessions, with technology stocks bearing the brunt of the selling pressure. The S&P 500 declined 36.83 points, closing at 6,656.92, representing a 0.55% drop from the previous session. This pullback came after the index had been trading near record highs, highlighting how quickly sentiment can shift in today's markets. The Dow Jones Industrial Average showed relative resilience, falling just 88.76 points to 46,292.78, a modest 0.19% decline. This outperformance reflects the Dow's lower exposure to high-growth technology stocks that faced the heaviest selling pressure. However, the Nasdaq Composite took the biggest hit, tumbling 215.50 points to close at 22,573.47, marking a significant 0.95% decline. This tech-heavy index's underperformance underscores how Powell's comments about elevated valuations specifically impacted growth stocks. The Russell 2000, representing smaller cap companies, fell 5.83 points to 2,457.51, a 0.24% decline, suggesting that the risk-off sentiment wasn't limited to large-cap stocks. Moving across the Atlantic to European markets, we observed a similar cautious tone. The FTSE 100 in London dropped 31.75 points to 9,191.57, representing a 0.34% decline. The German DAX showed remarkable resilience, falling just 21.50 points to 23,589.83, a mere 0.09% decline. This relatively strong performance in Germany suggests that European investors may be viewing their markets as somewhat insulated from immediate US monetary policy concerns. In stark contrast to the Western sell-off, Asian markets painted a decidedly different picture. The Nikkei 225 in Tokyo actually gained ground, rising 136.65 points to 45,630.31, a solid 0.30% increase. This strength was driven by technology shares and continued foreign inflows into Japanese equities. The Hang Seng Index in Hong Kong delivered the day's most impressive performance among major indices, surging 403.76 points to 26,562.88, representing a robust 1.54% gain. This strength in Hong Kong likely reflects both technical buying after recent weakness and continued optimism around potential monetary policy easing globally. Federal Reserve Chair Powell's market warning, the key catalyst. The primary driver behind yesterday's market action was Federal Reserve Chair Jerome Powell's speech at the Greater Providence Chamber of Commerce. Powell's comments sent shockwaves through financial markets and provided crucial insight into the Fed's current thinking. Most significantly, Powell stated that equity prices are fairly highly valued, a rare direct comment about market levels from the typically market-neutral Fed chair. This assessment immediately caught traders' attention, as Fed officials rarely make such explicit observations about asset valuations. Powell emphasized the challenging balancing act the Federal Reserve faces, noting that the downside risks to employment have risen, while uncertainty around inflation's path remains elevated. This dual concern illustrates the complex environment facing monetary policymakers as they navigate between supporting a weakening labor market and maintaining vigilance against inflationary pressures. The Fed chair reinforced that monetary policy is not on a preset course, emphasizing the central bank's data-dependent approach to future rate decisions. This statement suggests that markets shouldn't assume automatic rate cuts and should prepare for policy pivots based on incoming economic data. Powell specifically warned about the risks of moving too aggressively with rate cuts, stating that such an approach could leave the inflation job unfinished and need to reverse course later. Conversely, he acknowledged that keeping rates too high for too long could cause the labor market to soften unnecessarily. This nuanced messaging reflects the Fed's current position following their recent 25 basis point rate cut to the 4.004.25% range. Powell described this stance as still modestly restrictive, but noted it leaves the Fed well positioned to respond to potential economic developments. Economic data releases, mixed signals on growth trajectory. Several key economic indicators released yesterday provided mixed signals about the underlying strength of the global economy, contributing to market uncertainty. The S&P Global U.S. Services PMI came in at 53.9 for September, down from 54.2 in August, meeting expectations but indicating a slower pace of expansion in the crucial services sector. This reading suggests that while the services economy continues growing, momentum has moderated from recent highs. The S&P Global US Composite PMI fell to 53.6 in September from 54.6 in August, also reflecting this broader deceleration in economic activity. Despite remaining above the 50 threshold that separates expansion from contraction, this decline indicates that overall economic momentum is softening. In the United Kingdom, economic data painted an even more concerning picture. The UK services PMI plummeted to 51.9 in September from 54.2 in August, well below the expected 53.5. This sharp decline represents the weakest services sector performance since June and suggests that the UK economy may be losing steam more rapidly than anticipated. Even more troubling, the UK manufacturing PMI fell to 46.2 in September from 47.0 in August, marking the steepest contraction since April. This reading, well below the critical 50 threshold, indicates that UK manufacturing activity is contracting at an accelerating pace, with survey respondents citing weak domestic and export orders. The weakness in UK manufacturing was attributed to several factors, including disruptions in the automotive supply chain due to plant stoppages at Jaguar Land Rover. Additionally, employment in the sector continued to decline, while business confidence, despite reaching its highest level since February, couldn't offset the current operational challenges. Technology sector under pressure, AI giants face reality check. The technology sector bore the brunt of yesterday's selling pressure, with several major artificial intelligence and cloud computing leaders experiencing significant declines. NVIDIA, the AI chip giant that has been one of the market's biggest winners, fell 2.82% to close at $178.43. This decline came despite the company's continued dominance in the AI semiconductor space and follows Monday's surge tied to its $100 billion OpenAI investment announcement. The pullback suggests that investors are questioning the deal's structure and the heavy energy requirements associated with expanding AI operations. Amazon experienced one of the day's steepest declines among mega-cap stocks, dropping 3.03% to $220.74. This decline reflects concerns about the company's cloud computing division, Amazon Web Services, which has been growing slower than competitors from Google and Microsoft. Despite AWS posting 17% year-over-year revenue growth last quarter, this pace lagged behind Google Cloud and Microsoft Azure, both of which achieved over 30% growth rates. Microsoft fell 1.01% to $509.23, while Salesforce declined 2.07% to $244.53. These declines in established cloud and software leaders suggest that Powell's comments about high valuations particularly resonated with investors holding expensive technology stocks. Oracle suffered one of the day's worst performances among major tech names, falling 4.4%. This significant decline likely reflects concerns about the company's exposure to the enterprise software market and questions about sustainable growth rates in a potentially slowing economic environment. Interestingly, some technology stocks bucked the trend. Intel gained 2.02% to $29.34, likely benefiting from its lower valuation and potential for market share gains in certain semiconductor segments. Advanced Micro Devices also managed a 0.69% gain to $160.90, suggesting that investors may be rotating toward more reasonably valued semiconductor names. Political developments. Trump's UN address shakes global relations. Yesterday's political developments added another layer of complexity to market dynamics, with President Donald Trump delivering a combative speech to the United Nations General Assembly that criticized international allies and outlined aggressive policy positions. Trump's address took aim at multiple issues that could impact global markets. He threatened to impose very strong rounds of powerful tariffs on Russia should Moscow not agree to peace negotiations regarding Ukraine. However, he also criticized European nations for continuing to purchase Russian oil and gas while simultaneously fighting Russia, calling the situation embarrassing to them. The president's comments on immigration proved particularly provocative, telling world leaders that your countries are going to hell, and criticizing what he termed uncontrolled migration. Trump specifically attacked London Mayor Sadiq Khan, calling him a terrible, terrible mayor, and making the extraordinary claim that London wants to go to Sharia law. On climate policy, Trump encouraged leaders to reject policies aimed at fighting climate change, falsely calling climate change the greatest con job ever, and warning that, if you don't get away from this green scam, your country is going to fail. These comments could impact renewable energy and ESG-focused investments globally. Ukrainian President Volodymyr Zelensky provided a somewhat more optimistic perspective, telling Sky News that Trump's new stance on Ukraine represents a big shift, with Trump apparently ready to provide security guarantees to Ukraine after the war concludes. This development could influence defense sector stocks and geopolitical risk assessments. The political tensions extend beyond the US, with various European leaders responding to migration and economic challenges. These developments contribute to the overall uncertainty that markets face when assessing geopolitical risks and the potential economic impacts. Cryptocurrency market carnage, red September, intensifies. The cryptocurrency market experienced one of its worst sessions in months, with the total market capitalization falling to $3.87 trillion amid what analysts are calling red September 2025. Bitcoin declined 0.39% to close at $112,418.03, remaining below the critical $113,000 resistance level. Despite this relatively modest daily decline, Bitcoin has been trading in a volatile range between $111,000 and $115,000, with technical analysts noting that the cryptocurrency needs to maintain support above six-figure levels to preserve its long-term bullish outlook. Ethereum fared worse, falling 0.80% to $4,166.19. This decline extends Ethereum's recent weakness, with the second-largest cryptocurrency facing pressure from ETF outflows and broader seasonal weakness that has historically plagued September performance. The broader cryptocurrency market saw a massive $162 billion sell-off that has dramatically reduced the total market capitalization. This decline is being driven by multiple factors, including a strengthening US dollar, regulatory uncertainties, and large liquidations of leveraged long positions worth over $1.65 billion. Interestingly, some altcoins showed resilience amid the broader sell-off. Avalanche, AVAX, and XRP both posted gains, suggesting that investors may be rotating toward alternative cryptocurrencies that have underperformed during the recent AI and large-cap crypto rally. The September weakness follows historical patterns, as September has traditionally been one of the worst months for cryptocurrency performance. Bitcoin has averaged negative returns of approximately 8.74% during September over the past several years, earning the month the nickname September Curse among crypto traders. However, some analysts remain cautiously optimistic about the fourth quarter. Historical data suggests that when September ends on a positive note, the following months typically see significant rallies extending into year-end and the following year. With September 2025 currently showing a slight positive return of 3.26% month-to-date, this could potentially set up for a strong finish to the year. Central bank policy divergence, global monetary landscape. The monetary policy landscape continues to evolve globally, with central banks taking different approaches to address their respective economic challenges. The European Central Bank recently decided to keep its three key interest rates unchanged in September, with inflation currently around the 2% medium-term target. ECB officials noted that their assessment of the inflation outlook remains broadly unchanged, with new staff projections showing headline inflation averaging 2.1% in 2025, 1.7% in 2026, and 1.9% in 2027. The Bank of England maintained its bank rate at 4% in September, with the Monetary Policy Committee voting 7-2 to hold rates steady. Two members voted to reduce rates by 0.25 percentage points to 3.75%, indicating some division within the committee about the appropriate policy stance. Sweden's central bank provided a surprise by cutting rates by 25 basis points to 1.75% in September, aiming to boost economic growth and control inflation despite ongoing geopolitical tensions and uncertain U.S. trade policy. This divergence in monetary policy approaches reflects the varying economic conditions across major economies. While some central banks are easing policy to support growth, others remain cautious about inflation risks, creating complex cross-currents for global financial markets. Sector performance analysis. Defensive rotation emerges. Yesterday's market action revealed clear sector rotation patterns that provide insights into investor sentiment and positioning. In the defensive sectors, utilities and consumer staples outperformed as investors sought stability amid policy uncertainty. This rotation typically occurs when investors become concerned about economic growth prospects or when market valuations appear stretched. The financial sector showed mixed performance, with some banks benefiting from expectations that interest rates may remain higher for longer, while others faced pressure from concerns about potential economic weakness that could impact loan demand and credit quality. Healthcare stocks demonstrated resilience, with companies like United Health gaining 1.87%. This sector's defensive characteristics and relatively attractive valuations compared to high-growth technology stocks made it appealing during the risk-off environment. Energy and materials stocks showed mixed results, reflecting the complex interplay between economic growth concerns and ongoing supply-demand dynamics in commodity markets. The sector remains sensitive to both global growth expectations and geopolitical developments. The real estate sector faced headwinds, declining 1.8% in some markets, likely reflecting concerns about higher interest rates for longer and their impact on property valuations and financing cost. Economic calendar. Looking ahead, key data releases. Several important economic data releases are scheduled for the remainder of the week that could significantly impact market direction. Wednesday, September 24th, new home sales data for August will be released, providing insights into the housing market's health amid elevated mortgage rates. This data will be crucial for understanding consumer confidence and the broader economic outlook. Thursday, September 25th, the second quarter GDP revision will be published, along with existing home sales data for August. These releases will help investors gauge the economy's underlying strength and momentum heading into the fourth quarter. Friday, September 26th, the core PCE price index, the Federal Reserve's preferred inflation measure, will be released. This data will be particularly important given Powell's recent comments about inflation uncertainty and could influence market expectations for future Fed policy decisions. Additionally, various regional manufacturing indices and consumer sentiment measures will provide further insights into economic conditions across different segments of the economy. Implications for investment strategy. The current market environment presents several key considerations for investors navigating these uncertain conditions. Valuation sensitivity. Powell's comments about fairly highly valued equity markets serve as a reminder that stretched valuations can make markets vulnerable to negative news or sentiment shifts. Investors should consider portfolio positioning that accounts for potential volatility. Sector diversification. The rotation from high-growth technology stocks toward defensive sectors suggests that broad diversification may be particularly valuable in the current environment. Investors overweight in technology may want to consider rebalancing. Interest rate sensitivity. With the Fed's policy path remaining data-dependent, assets sensitive to interest rate changes may experience continued volatility. This includes both growth stocks and interest rate-sensitive sectors like real estate and utilities. Global considerations. The divergence between US, European, and Asian market performance highlights the importance of geographic diversification and understanding regional economic dynamics. Cryptocurrency exposure. The significant volatility in digital assets suggests that investors should carefully consider their risk tolerance and position sizing in this asset class, particularly given the historical weakness typically seen in September. Market outlook and risk assessment. Looking ahead, several factors will likely drive market performance in the coming sessions and weeks. Federal Reserve policy. The central bank's data-dependent approach means that upcoming economic releases will be crucial for market direction. Any signs of accelerating inflation or significant labor market weakness could prompt policy responses that impact asset prices. Geopolitical developments. The ongoing tensions highlighted by Trump's UN speech, combined with various international conflicts and trade considerations, continue to create an uncertain backdrop for global markets. Earnings season approach. As third-quarter earnings season approaches, investors will be closely watching corporate guidance and commentary about business conditions, particularly in light of concerns about elevated valuations. Seasonal factors. September has historically been a challenging month for both equity and cryptocurrency markets. Understanding these seasonal patterns can help investors prepare for potential volatility. Economic resilience. The mixed economic data suggests that while growth continues, momentum may be moderating. This environment requires careful assessment of both growth and value opportunities. Conclusion: navigating uncertainty with disciplined approach. Yesterday's market action, dominated by Fed Chair Powell's valuation warning and broad-based technology sector weakness, underscores the importance of maintaining a disciplined investment approach during periods of uncertainty. The mixed global market performance, with Asian markets advancing while US and European markets declined, highlights how regional factors can create divergent outcomes even in our interconnected global economy. The cryptocurrency market's significant sell-off, combined with the Red September phenomenon, serves as a reminder of the volatility that can emerge in risk assets during seasonal weakness periods. Powell's emphasis on data-dependent policy and the balancing act between employment and inflation concerns suggests that markets will remain sensitive to economic releases in the coming weeks. Investors should prepare for continued volatility while focusing on fundamental value and diversification. The political developments, from Trump's UN address to various international tensions, add another layer of complexity that requires ongoing monitoring and assessment. As we move through the remainder of September and into the fourth quarter, successful navigation of these markets will require staying informed about economic developments, maintaining appropriate risk management, and avoiding the temptation to make dramatic portfolio changes based on short-term market movements. The current environment rewards patience, discipline, and a focus on long-term investment objectives rather than attempting to time short-term market movements. With valuations elevated in some areas and significant uncertainty about policy directions, careful security selection and risk management remain paramount. Thank you for joining today's market analysis. Stay informed, stay disciplined, and we'll see you tomorrow for another comprehensive review of global market developments and their implications for your investment decisions. Sources and key data points referenced: major index closing levels from Financial Times, Trading Economics, and other financial data providers, Federal Reserve Chair Powell's speech transcript and analysis, economic data releases from S&P Global, ONS, and other statistical agencies, political developments from major news organizations, cryptocurrency market data from various digital asset platforms, sector performance analysis from multiple market data sources. This analysis is for informational purposes only and should not be considered as investment advice. Always consult with qualified financial professionals before making investment decisions. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel.